In this video, I'm talking about salary sacrificing, and I'm going to give you some tips and help you avoid some of the traps. Now, this is a bit more of a practical approach, and I'm adding to my last video, salary sacrificing part 1. We know that salary sacrificing allows people to save money, pay less tax, and build up their super balance. But there's a range of complex rules. Now, everything in this video will be covered under general financial advice and factual information because it doesn't take into consideration your personal financial goals, needs, or objectives. There's a range of rules about getting money into superannuation, and there's a lot of tax incentives to help you save for your own retirement. Here's a couple of the main rules. At the moment, the concessional contributions limit is $25,000 per annum. That includes your employer contributions, any salary sacrificed amounts, and personal contributions. Now, your employer contributions, you might know that as either the superannuation guarantee or your 9.5%. Now, when you put money into superannuation, you are restricted by age. Now, from age 18 to age 65, you have to stay under the contributions caps. When you're age 65 to age 75, you've got to meet a work test. That's where you work 40 hours over 30 consecutive days within the financial year. Now, the government's made a range of changes over the last few years, 2015, 16, 17, and even 18, around superannuation. Now, some of them are really going to help people address some of the problems of getting money into superannuation. So I think there's a huge opportunity for people to get more money into super, which means saving more tax and building up your super balance. When it comes to superannuation, for me, the positives definitely outweigh the negatives. If you're looking to set yourself up for retirement, that means a larger superannuation balance, more financial security, and less reliance on the age pension. At the same time, there's also the opportunity for intergenerational wealth transfer. For people who are looking to purchase their first home under the government's First Home Super Savers Scheme, salary sacrificing allows you to save money by paying less tax, which means you accumulate that same amount of money much faster. I've got a separate video where I cover the tax savings were about $10,000 for a young couple. Here are a couple of things that impact people who are building up their superannuation. For example, from age 35 to age 50, when you contribute money into super, it can change the need for insurance over time. Also, you can even up your superannuation balances between two people in a relationship, so husband and wife. One may not be working, but still wants to have money inside super. And the government recently announced the catch-up concessional contributions, where people are able to use previous years of their unused cap in the future. Superannuation has a range of complex rules that apply to different people at different times. So getting money into superannuation and then when you can access that money. So we're talking about concessional contributions caps on the way in and then accessing that money through things like transition to retirement income stream. Might be when you can access your superannuation in the future. That may change because we have problems with an aging population and longevity risk. Also, when you salary sacrifice, there's going to be some changes to cash flow. So what I mean by that is if you earn $80,000 pre-tax, you salary sacrifice 10, your assessable income would be $70,000, which you'd then pay tax on, and that is going to be lower than if you were just earning $80,000 straight away. Let's move on to the process of how to salary sacrifice with your employer. There are 4 main steps. The first one is you should do a budget. I've got a separate video where I take you through the process of how to put a budget together. The second thing you want to do is decide on how much you want to salary sacrifice. For some people it might be $5,000, others it'll be $10,000, $12,000, or $15,000. It just depends on your circumstances, which means the amount of money you save is going to be different to somebody else. Step number 3 is about having a conversation with your employer about the terms and agreements of salary sacrificing money into super. Now, I've got a really important example coming up shortly to explain why you need to get confirmation in advance of how your salary sacrifice will be treated. The final step is talking to payroll to organise the payment into your superannuation fund. Now, that might be an industry fund, a corporate fund, a retail fund, or a self-managed super fund. Now, your employer's payment process might differ, and once again, there's a few traps around that coming into the end of financial year. Ideally, you'd set up salary sacrificing at the start of the financial year to help you save. So an example would be if you're looking to salary sacrifice $15,000 split evenly over 12 months, it would be 12 contributions of $1,250. Let's go through some common problems that I see. The first one is capacity problems, and then the second one is difficulty with your employer's payment process. Now, when I look at capacity problems, it typically falls into two areas. The first one is budget related. So we're talking cash flow and savings. Essentially, you don't have the spare cash available to contribute money into superannuation. The second part actually falls into income related issues. So this idea is the cost of living is high relative to your income. Let's go through an example of capacity problems with budgeting and cash flow. First of all, we're going to look at this over April, May, and June, not over a 12-month period, because I want to highlight how leaving it to the last minute can be quite difficult to get money into superannuation. We're going to assume that someone earns the average annual salary, $81,500, and they're looking to salary sacrifice $5,000 into super. So without salary sacrificing, they earn $81,500 over the quarter. That's $20,400 after tax. It's $15,900. Now, in that same situation, if that person decided to salary sacrifice $5,000 over April, May, and June, we can see that money would go into superannuation. Their assessable income over a 12-month period would be $76,500, and their assessable income over April, May, and June would be $15,400. So their after-tax income would be $12,500. And that's a difference of $3,400 over a 3-month period. The second biggest problem I see has to do with an employer payment process. Now, companies are different in how they approach this, but it can be broken down into two different areas. The first one has to do with timing, and the second one has to do with the approach to the rules. Big mistakes around payment timing can either lead to breaching your concessional contributions cap, which means you have to pay excess concessional contributions tax, or you have to request a refund of your concessional contributions. I know that's a bit of a mouthful, but it's not as bad as what it sounds. When it comes to payment timing, we're talking about the fact that your employer is legally allowed to make your superannuation guaranteed payment up to 28 days after the end of the quarter. So an example would be your contributions for January, February, and March would legally allowed to be paid before the 28th of April. Now, if we were to look at this in April, May, or June, and they were to pay it in the next financial year, that would cause some problems. So a good business typically makes salary sacrifice contributions into super before the end of the financial year for that specific reason. Okay, two common problems with payment timing. Number one, working out whether your employer has actually paid your superannuation guarantee. And then the second part is when your superannuation fund receives that amount. So worst case scenario, you miss this financial year and it goes into next financial year, and unfortunately you don't save the tax that you could have. So that's why making personal concessional contributions can really have an impact on your circumstances. When it comes to rules, this is one of the biggest traps that I want people to avoid. I want you to talk to your employer and make sure you have an understanding of how salary sacrificing works and what you're agreeing to. Now, first of all, we're going to assume a $100,000 salary in this example, and then in the second one, we're going to salary sacrifice $15,000. So as you can see from this table, first example, the 9.5% is $9,500. In the second column, the 9.5% is actually worked out off $85,000. So it's $8,075. The difference is $1,425. This is why you should speak to your employer about your superannuation guarantee being paid off your pre-salary sacrificed amount. In this video, I've spoken about the rules and the processes, as well as some of the things that I think are positive and negative about superannuation and salary sacrificing. With that said, there are a number of takeaways. First of all, salary sacrificing allows you to save money, pay less tax, and build your superannuation balance. At the same time, that means that you're going to have more financial security in the future. In the long run, I think more people should salary sacrifice money into super because it's going to put them in a better financial position with an aging population. With that said, thank you very much for watching. If you've got any questions, you can always get in contact with me. My name's Chris Tobin. I'm a financial advisor. Thank you very much.